Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda.
It's Fed Day. The central bank is set to deliver a hawkish hold, but leave the door open for another hike. 5- and 10-year Treasury yields hit the highest levels since 2007. Meanwhile, the pound falls as the UK's unexpected drop in inflation eases the pressure on the Bank of England to hike tomorrow. And angst in the ranks. Mike Mayo says Goldman Sachs CEO isn't leaving anytime soon, despite the growing criticism of David Solomon's colleagues. Danny, good morning. We just got to focus in on the Treasury market. It's popping. It wasn't the clouds of smoke that came from Canada yesterday. It was the angst about inflation that caused a pop and roll in yields. You're looking at the highest yield since 2007. We get the dot plot today. Will the dot plot tell us 100 basis points of cuts 2024? That is the only thing the market is interested in. How hawkish or dovish tilt will the hike, will the pause possibly be? Cable getting trashed this morning. The CPI, this was the shocker, and the core CPI. So CPI at the headline comes in at the lowest level in 18 months. And this has given the sterling burrs everything that they wanted. Hugh Pill at the Bank of England talked about Table Mountain. It could be that you see some kind of a dovish pause, or maybe even one more hike and done. Sterling down this morning. You're going to have to see a disappointment from the Fed, maybe, to bolster the pound. And Brent, 92.95. What you got here is, of course, Goldman Sachs, who are one of the big bull protagonists, again calling for $100 oil. They say deficits will take shape in the third quarter. They say most of this vital commodity rally is done, but that OPEC will sustain 80 to $105 oil. So at the moment, we give a little bit back across these markets, but it is angst in the ranks in the macro picture. Good morning, Danny.
Good morning, Manus. All I can say is now that you're getting paid in dollars, if sterling keeps doing that, lunch is on you next time you come visit. Look, bad news for the pound, maybe. Bad news for my wallet, maybe. But good news is good news, at least for this UK equity market. Mid-caps having a hell of a run this morning. They're up about 1.33%. That's being lifted by the home builders, by some of the multinationals. If you look at the FTSE 100, benefiting from lower rates and a weaker pound. European stocks up for the first day in 3. Meanwhile, S&P 500 futures, those are up 0.2%, gaining back after some of yesterday's losses. Bank of America, the team over there, just upgrading their year-end call to 4,600. It had been 4,300, which would have implied a drop. So they've upgraded it. Savita Subramanian over there saying that the macro indicators, the positioning, all of that reading more bullish. But the equal weighted Manus will do better than the market cap weighted of the S&P 500 futures. Okay, let me quickly show you Instacart. We had that IPO yesterday. Shares priced at $30. They went up to $34. Now we're back down at $32 in the pre-market session. So yes, Manus, they're still above where they had originally priced for. But come on, it is so gutsy to try to put an IPO into this market. Not only the week of the Fed, but the BOE, the BOJ, Norges Bank. I mean, so many central banks. Not exactly an easy debut.
No, it's not. But then, of course, some would say that ARM left some rich pickings on the table last week when they floated. So it is the land of the brave, which takes us to, I mentioned the dots. What will the dots tell us today? And I'm drawn to the macro compass by Alfonso Peccatiello. I think the dot plot, I love this, is pure gaslighting. The Fed is just telling us their median reaction function, given the information that they have today. It's not a prediction, but it might still move the markets. And therein lies the point, Danny Berger, which is, do the dots matter? Do you listen to the Treasury Secretary, the former Fed chair? Do you listen to Powell? When it suits them, they matter, and when it suits them, it doesn't.
Yeah, and how much conviction will even be behind those forecasts? As Anna Wong from Bloomberg Intelligence points out, you have UAW strikes, and at the same time, a potential government shutdown. Can they really promise another hike if it's in the dots? So, Manus, okay, we are preparing for today's Fed decision, but one thing that caught us off guard, unwound some of the yield move, was that UK CPI. It unexpectedly fell to the lowest in over a year, and it does open the prospect that the BOE could pause. Let's get over to Bloomberg's Valerie Teitel, who has a breakdown of the numbers for us. Valerie.
Danny, the inflation print out of the UK today was soft across the board. The breadth of this print today was wide. It wasn't driven by one-off factors, but across the entire inflation basket. A big relief when it came to the core CPI print, falling from 6.8% to 6.2% today. And also services inflation, which has yet to show a peak in the UK, finally did so today. It fell from 7.4% previously to 6.8 today. That is a big drop in the very, very sticky component of services inflation. The market reaction so far is clear. The Bank of England might not need to hike that much more. It was only 2 weeks ago we priced 2 more hikes from the Bank of England in this cycle. We're now down to pricing just 1 more. And in fact, for tomorrow's meeting, Danny, we're now pricing a 50-50 chance of that hike. If they do go ahead and hike, the market does expect some sort of signal from Bailey that we are near the peak. Very similar mantra that Lagarde gave us last week. But after this inflation print, really the only thorn in Bailey's side is that high wage inflation, that pay growth. It is looking like inflation for now, especially core inflation, is playing ball for the Bank of England.
All right, a nice edge decision tomorrow. Valerie, thank you so much. Valerie Teitel there. Let's bring in now Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, great to see you. Thanks for coming in this morning. All right, so front end of the UK gilt curve off by about 13 basis points. Do you agree with what the market is starting to price in, that we might get a pause tomorrow from the BOE?
No, this is an absolute knee-jerk reaction. You just have to think, headline CPI, core CPI, they're more than 3 times the target level. This is not the point that the Bank of England can rest. And Valerie just said a really important point there, which is it's all about wage pressures, because the concerns are that there are secondary impacts, which means that you have inflation sustained at a higher level. This is very sticky inflation. So this is undoubtedly good news to see inflation coming down more than expected, or even coming down. But I think this is far too early to say that we're at the end of the cycle. I think what it does do, though, is, of course, it does suggest that maybe they're closer to the end than maybe markets had been originally thinking. But remember, this is not just good news. The reason that inflation is coming down in the UK is also because there is an economic slowdown happening.
So they need to balance that, though. So is there a potential Trichet moment coming? We talk about it with the ECB. Does it apply to the UK that they could overdo it if they keep pursuing hikes at this point?
Well, I think the Bank of England has probably the hardest job of all the central banks at the moment because of the visible growth slowdown that we're already seeing and the fact that inflation is the highest over here of some of the G7 countries. So yes, there is a chance of overdoing it. But also, from central bank speak, the concern is always going to be about inflation becoming really entrenched. So they have got a very difficult balancing act. I would say that today it's too soon to think about a pause. But are they going to continue to hike every month, every meeting? Probably not, given the unveiling data.
Seema, good morning. Good to see you. Yeah, they don't want another existential moment of angst. But you set the table, a very salutary warning, which is don't be bluffed by this CPI print. I reflect back to what Hugh Pill had to say, which is, this was at his speech in South Africa. He wanted to try and get a Table Mountain-like situation. But he talked about fewer risks of financial stability, imposing fewer risks of financial stability. How stable, how liquid, how concerned are you that there is some angst in the UK at the moment, that we risk a policy accident?
Well, I'd say so the financial stability risks, I would agree, they are quite contained. We're not seeing any really visible signs of stress. The thing is that central banks always have to stay alert. As long as rates are going up, as long as we've got this bond sell-off in play globally, there is always going to be a risk. But for the Bank of England specifically, the greater concern is just about what the economic downside is. How far do they need to go in order to contain inflation without really tipping it into a deep recession, which has then sustained and permanent damage on the UK economy?
And herein lies the point. We had Nura Rabini with us just the other day, and he said the UK is going to be the worst of all stagflation scenarios. And I think off camera and on Instagram, he said, in stagflation galore. Would you go as far to call that kind of a turgid situation for the UK economy?
That is a risk. I'm not sure if I'm going to go as far as to say that's the baseline scenario. I think, at least the data that's coming out from inflation today is certainly it's encouraging. But as I said, that is a risk. It's also the risk for Europe as well, that is stagflation takes over. But, we're moving in the right direction. but you probably do need a little bit more work. And the fact, as long as stagflation is the term that is being thrown around, I think it just goes to show how cautious and careful the central banks have to be in maintaining some of that pressure that they have.
Can you touch the gilt market in the meantime? If we are going to see gut punch reactions like today, as you say, it doesn't necessarily make sense that they'll need to hike again. Can you touch the market?
It's a tough one. I think generally bond markets at the moment are very difficult to read. You know, I think we're at a turning point for a lot of central banks. You know, we kind of consider it the last mile. And typically when you're getting to that last point, equity markets, bond markets are all very volatile. It's very difficult to get a clear reading. So in a way, you have to take more of a 1 or 2 year perspective. You know, what do we think is going to be further out? And from that regard, yeah, maybe you want to have a bit of exposure to gilts, to treasuries, especially when you think that there's an economic slowdown coming. You want to have that kind of protection.
Where does the pound play into this, Seema? If you want to take a little bit of exposure, let's say, to the gilts, etc. You look at the pound. The pound has rallied by about 20%. I mean, it's off its highs from that Trussonomics debacle. Here we are. It gives a little bit back over the summer. What role does sterling play for the Bank of England? It's in that comfort zone, I would say, would be my take. Your take?
Well, I'd agree. It's in a comfort zone. I actually don't think that sterling is going to really play a big role for the Bank of England's decision-making at the moment. Having a weaker pound is obviously going to be helpful, given that we have an economic growth slowdown ahead, or even here right now. So I don't think it matters as much. I think it matters less, certainly for a lot of other central banks out there. And, you know, of course, it does add to the inflation pressures slightly, but typically the Bank of England puts a lot less emphasis on sterling than you do from the ECB or Bank of Japan, for example.
OK, well, there's a certain level of paranoia, isn't there, at the Bank of Japan at the moment, and we'll get a little bit more on that before the end of the week. Seema, stay with us. It's great to have you in the studio this Wednesday morning. Coming up in the show later in the hour, we'll catch up with the UBS chief economist, Paul Donovan. Is he duped by the false dawn, maybe, from the CPI? We're also going to discuss the future of David Solomon. As a top bank analyst, Mike Mayo remains positive. He's not leaving anytime soon, despite the growing criticism this year. Right here on Bloomberg. Good morning.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. The Fed certainly has started to gear up for a hawkish Fed decision today, Manus. 5s and 10s. Yields broke the highs of the cycle, if I can get my words together, yesterday. We had basically a 6 basis point move for both of those. The 2-year yield may be an exception. That did hit an intraday high, but then pulled back. Still, this market is not yet pricing in another hike from the Fed this year, firmly pricing in a pause for today. Still with us is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, PIMCO thinks that we're underestimating the risk of another Fed hike this year. Do you think we're underestimating that risk?
There is always a risk, especially when you've got oil prices moving up, right? And we know that the Fed, I think, has to be looking at the last 2 years and remembering that maybe they overlooked some of those concerns a bit too much. But generally speaking, we are expecting the economy to slow down. You know, the question of recession is a tough one, but certainly an economic slowdown. We're seeing inflation moving in the right direction, at least for now, especially on the core inflation side. So actually, for us, we think it's a pause. We think that rates have peaked. But I think from the Fed's perspective, and certainly for Powell today, it's really important to maintain a bit of a hawkish message. So, you know, it serves them well to almost have that additional rate hike in the dot plot, maintain that pressure, because the last thing they want to see now is for financial conditions to start loosening, and then you reinvigorate inflation pressures. Financial
conditions are quite loose at the moment, though. Manus and I have talked about this extensively. If you look at FCON from the Bloomberg guide, it has shown it's still not really moving that far above zero. The fiscal picture comes into play with that, too. I mean, are conditions even too easy right now? Again, once you factor in the spending from the federal government?
I think it is. And, you know, with the financial conditions, a lot of it is because the credit market continues to be very healthy. Obviously, equities have done well, although petering out a little bit recently. Yes, for the Fed's perspective, they do need to have tighter financial conditions. But, you know, this is one of the balances that they have to take is, you know, they don't want to destroy the economy, but they also have to keep that very, you know, one eye very closely trained on inflation and where they want that one to go.
So, Seema, it is in theory all about the guidance from the dots. To what extent should we bank on them? I mean, I started the show by saying Alfonso over at Macro Compass says, look, the dot plot is pure gaslighting. But the dot plot, according to the Fed, is 100 basis points of a cut the last time out in 2024 and 125 going through to 2024 and then through to 2025, 125. How much are you banking on the dot plot as a real steer for forward guidance?
We're not, and actually, I love that quote from him. Gaslighting, I think, is correct. And, you just have to look back at the last couple of years and just think about what the dot plot had been indicating and then actually what they ended up doing with policy to know that it is just a forecast. It's very data dependent. But I do think that there's a bit of messaging in there from the Fed at this stage where they're trying to give us the indication that, look, there is always a threat of further rate hikes if inflation doesn't play ball. So, as I said, it doesn't serve them well to suggest that we're at a pause, which could maybe reinvigorate inflation pressures. So I think it's important to watch it, but I don't know if it would necessarily change my forecast that we think that the Fed is already at its peak.
Tell me whether I'm misguided. A lot of people do on a continual basis. But if the dot plot says 225 basis points of cuts over the next 2 years, you'd have to have some kind of I don't know, you described the recession to me. It would have to be quite a sort of a brutal punch to the economy to deliver 225 basis points of cuts.
I mean, I would agree. I mean, we are actually expecting a very, very mild recession next year. So starting in Q2, lasting 2 quarters, very, very small peak to drop. The big thing is, of course, what goes on with unemployment. But even within our forecast, we're only expecting 3 rate cuts next year, so 75 basis points of cuts next year. So for the Fed at the same time to be saying that they don't expect recession, but then maybe to continue to have in their dot plot numerous rate cuts, it is slightly at odds. So I think that's a fair point.
Does United Auto Workers strike unfolding and a potential government shutdown, how do those 2 things feed into your outlook?
It doesn't feed into it too much. From the inflation side, I think it's actually quite small. Maybe the strikes invigorate a few more wage demands across the economy. That's something that we need to watch. The bigger concern is really on the growth side, and I think that's where the threat is. And from the Fed perspective, it's another risk out there, which to me says, don't hike any further, but then keep the eye on the oil prices and everything else. That's a reason just to stay on hold for longer. So no rate cuts until you have clear evidence, maybe, that the labour market is starting to move into a downturn.
Seema, when you look around the world, where are we in the evolution of the wage narrative? It's been sticky inflation has been driven by services around the world, in Europe, in the US, and even in Japan, which we go towards on Friday. It's about, will we have enough data on the wages side to shift from yield curve control? Are we missing a beat here in the higher for longer narrative? It is wages are now moving into a new paradigm. Is there a shift? Is there a global shift that we need to reprice?
It's a good question. I mean, I do actually think that is one of the key questions when you're starting to think about beyond just the next 3 months and looking out over the next couple of years. It is about wage demands. The thing is, if you look at real wages, they're only just starting to move into positive territory. Real wages have been negative. That's why a lot of households have continued to be pressured. So this is almost a healthy development in some ways, which is why a central bank like the Bank of Japan wants to almost maintain a little bit of that pressure, but then keeping an eye out to make sure it doesn't take off too much. For the US, I think it's a difficult situation in a way because you are starting to see a little bit of unrest, feeling that households are struggling too much and therefore they require further wage demands. So it's one thing that we have to keep watching. I generally think that a lot of the negotiating power is starting to shift back away from employees back to employers. So maybe some of that wage growth is going to start fading in the next few months.
Well, certainly the back to work and back to the office narrative is driven very much by the fear of recession, by the fear of slowdown, and that's got a consequence in terms of the balance of power between employer and employee. Seema, stay with us. More work to do. We got you up early. Let's make value with you in the house. Coming up on the show, Goldman CEO David Solomon. He's drawn criticism in the past year over lackluster earnings, but Mike Mayo believes he's safe in the role for now. We discuss what the analyst says on Wall Street.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, Manus, the coverage of Goldman CEO David Solomon has been pretty brutal. I think there was even a New York Post story at one point talking about awkward dinner parties he was throwing. But as part of the mea culpa, Goldman continues to sell off its consumer assets. Latest reporting that they're going to be selling Green Sky to a consortium, including 6th Street.
And it's part of the fixing some of the problems. And this is Mike Mayo, the analyst, famed analyst across banks in Europe and here. He says Solomon's not going anywhere anytime soon. He met the board's lead director, and their conclusion is the CEO will stay in his role for the medium term, whatever the heck medium term is, Danny. And of course, they met with Adebayo Ogunlesi, who is the lead director. Yeah, in hindsight, they should have gone quicker. They should have punched it harder on the consumer front. But it looks as if they're putting that in order now. Will we have a little bit more?
I got to say that, that medium-term thing, just quickly say, that definitely stuck out to me. But you're right, man, it's coming up. Seema Shah, we'll get back with her, of Principal Asset Management on Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. It's Fed Day. The central bank is set to deliver a hawkish hold to leave the door open for another hike. 5- and 10-year Treasury yields hit levels not seen since 2007. Meanwhile, the pound falls as UK's unexpected drop in inflation eases pressure from the Bank of England to hike tomorrow. And angst in the ranks. Mike Mayo says Goldman CEO isn't leaving anytime soon, despite the growing criticism from David Solomon's colleagues. All right, let's get your quick check on markets here. We have that softer than expected UK inflation. That sets off mid-cap UK equities, thanks to home builders, thanks also to the multinationals. European stocks, Manus, those are up for their first day in 3, up 0.5%. Finally, S&P 500 futures climbing back some of the losses that they have seen. We saw an upgrade from Bank of America on their year-end call. 4,600 is the new figure for them. Quickly, let's switch it up. Let me show you what Instacart is doing this morning in the pre-market for its second day of trading. It debuted at $30, went up to $34 yesterday. Now it's back down to $32. So some of the wind being taken out of those sales, Manus.
Okay, Danny. Well, of course, that is the elixir of life to every central bank. Softer CPI, it gives them that caveat, it gives them that optionality to move out. And that's what's drowning sterling this morning and the short end of the curve. But across the assets, we have oil, we have currencies, and we have Fed Day, of course. On the oil market, Goldman Sachs, they were the big bullish call of $100. They were out of the traps early. They're back in there again. Brent will make it to $100. They've raised their Brent call from $100 to from $93 to $100. Now, they say most of the rally is behind us on sterling. Don't be fooled. Seema Shah said, don't be fooled by this softer CPI print that you have at the moment. Sterling is down. The swaps market now say 25 basis points of a hike on Thursday from the Bank of England. They're trimming back their overall estimates. And then, of course, it is the beginning of Fed Day. What will the dot plot actually tell us in terms of rate cuts for 24, rate cuts for 2025? How hawkish a pause will today be? But to the CPI in the UK, the elixir of life for caveat emperor for the Bank of England. And this is the performance on the short end of the curve, Danny. As you can see, a dramatic drop in the short end, the biggest one-day drop, I think, since June of this year. Do you want to believe that you're going to see maybe table mounting created by the Bank of England, as Hugh Pill said to us in South Africa just a few weeks ago? Danny.
Yeah, Manus, and as you pointed out, Seema Shah, who we're going to get back to shortly, did say, look through this one reading. It is just one reading. It doesn't make a trend. But we know the UK has consistently surprised to the upside when it comes to CPI. So it's interesting to put it in the global context of Canada getting a hot reading tomorrow. Does this make us perhaps rethink this narrative of sticky inflation everywhere? Perhaps the UK sets the cat among the pigeons.
Look, absolutely, and there's no doubt about it. It was the angst in the ranks in the macro policy from Canada yesterday. A hotter Canadian inflation reading really set off those bond markets in the New York session. But I think really over the next 24 hours, next 36 hours, we're going to get a redefinition of what G3 looks like.
Yeah, a lot to go through over the next few days. Let's do just that. Still with us is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, we're going to switch things up a little bit. We're going to do a little bit of a rapid fire and get really into these markets. So I want to get your quick take on some of these different assets. Let's start with risk. Let's start with equities. Is now a time to be long or short American equities?
I think this is the time to be neutral because I know this is going to be too quick, but the thing is that at the moment, it's going to be very difficult to get the timing right. We think there's going to be a bit of a pullback, but it's going to be quite short and shallow. So this is probably the time to be neutral and then look to edge in as you start to see economic downturn unfold.
See, Seema, you're quick but eloquent. It's amazing. All right. Tell me then about high yield, about junk bonds, obviously very correlated. Is it the same for that market?
It is. It's similar. So you do need to have some exposure because it's too good at the moment to avoid, or to not have. But at the same time, if we're expecting economic downturn, high yield is a bit which will be impacted the most. But again, it's not going to be impacted too hard because this is still a short, shallow downturn that we're only anticipating.
So short, shallow recession. Let's talk about then the opportune moment. I think you and Bob Michael must have had either a bit of lunch or a bit of breakfast. Bob Michael wants to buy every dip. Here you are. You say the bond sell-off, any bond sell-off is an opportune moment. Where in duration do you want to be?
So actually, we're thinking about longer duration at the moment. You know, we do think the economic downturn is coming. That's going to put downward pressure on that 10-year point. At the same time, you know, you can get in a 2-year, you can get in right in the front end. But really, this is a time to lock in any of the gains that you can get from a 10-year perspective. So actually, we're thinking longer duration rather than that short end point.
Equity risk premium is at a 20-year low. So what goes through my mind is how long of equities do you want to be? Or do I, and some would say, waste money and buy myself some protection, buy some VIX, which in theory is perhaps a little bit of value at the moment?
So really, VIX should be going up, but actually, I think we're having to rethink of the way that we think about volatility because it hasn't been moving in the way that we would anticipate. Equity risk premium, it is low. This is, I think, the time that fixed income is a little bit more attractive than equities, but it's fairly equally set at this point because there should be a rally once you come out of a bit of a dip in equities.
The dollar bulls and the bears have been equally shook, perhaps, this year. Those who thought that they could take positions against the dollar have been badly informed to the other way. Seema, we're going to get the BOJ later this week. Could we finally see a dollar downtrend in place?
I think you could, but it's not going to be too significant. You know, we do know that the Fed is going to be, we think, is going to be on hold for a while. So there's still that hawkish commentary starting to come out from them. So it's a bit of a downward move, but I don't think it's going to be very significant.
So I just did the big bullish call from Goldman Sachs there. They're back on this rampaging $100 oil and that OPEC are going to keep us there. I can't pin you. Well, maybe you will give me a pinned down answer on oil, but you have a broader church which I'll give to you. Do you want to be long of oil? Do you want to be long of commodities? Given the depth of recession that you think we're going to have?
So look, it depends entirely on what your time horizon is. If you're thinking about the next 6 months, I would be neutral because I think reading oil prices, given it's a supply move, it's a tough one to try and make a decision. If you're looking out over a longer term perspective, you should be overweight commodities because that supply shortages is only going to keep picking up. And we think oil prices, commodity prices, upward move over the next 5 to 10 years.
When does the rubber hit the road of higher oil impacting your other asset allocation? Is it $100 a barrel, as Goldman says? Is it something else? When does the rubber hit the road?
So let's say it hits about $120 a barrel and it's maintained there. That to us is a deeper downturn than we're anticipating. And at that point, I think you want to be really heavily into risk, into safer assets and risk.
All right. Looking at China then, that's another area where our assumptions have had to be challenged. When it comes to China exposure, whether you want to do it outright or perhaps in Europe, luxury, those sorts of things, can you buy China exposed assets right now?
I think it's a really tough one. So although the central bank and policymakers are trying to do more, I don't think it's going to be enough to convince investors to be increasing their allocations at this point. We would prefer other assets within EM which have a bit of a diversification to China. So India, for example, is a really key diversifier against China. If you have any concerns, increase exposure to India.
I like the way you frame the Indian narrative relative to China. It's not the perfect hedge, but it is something that you see as a contra to China. A lot of people are debating what the PBOC does next. Lots of incremental policies, but what is it that would shift the risk dial for China for you?
So if they really come in, aggressively on the property market. That is the only thing that's going to make any kind of move for the China economy. Interest rate cuts, if it's not hitting the property market, it just doesn't do enough because there is very, very subdued confidence at this point. I don't think you're going to see that bazooka move, at least for the time being, until you see maybe a deeper downturn. And at this point in time, given you're seeing that economic data is starting to bottom, I think maybe the central bank will be a little bit reassured and can sit back and rest again.
Seema, you've survived the rapid fire. I hope we don't scare you off. Please come join us again.
Absolutely not.
All right, Seema Shah there from Principal Asset Management, playing ball excellently, I might add. All right, coming up, we're going to continue the conversation ahead of a lot of central banks. UBS Chief Economist Paul Donovan joins us. This is Bloomberg.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation, and you could have a true stagflation.
That was the economist Noura Rubini speaking with Danny and myself on Monday. UK inflation for August unexpectedly fell to an 18-month low, easing the pressure on the Bank of England to hike tomorrow. Do they have the justification? Paul Donovan is the chief economist for UBS Global Wealth Management. Good morning, Mr. Donovan. Do they have the caveat that they need to pause, or would it be a mistake? Good morning.
Good morning. Well, the Bank of England is a very academic institution, and it has no problem with having very, very public and very, very significant internal disagreements. And I think that's what we're going to get tomorrow. We're going to get a very, very split decision. And I think it is now very, very finely poised as to whether they vote for, hopefully, one last hike or whether they decide to stand pats. It's not just the inflation data, it's a lot of the detail. UK inflation actually overstates what's happening with inflation in the UK. Food price inflation is actually lower than is being reported because supermarkets have this very weird dual pricing strategy. There's lots and lots of complicated factors here. So overall, if I was allowed a vote on the MPC, I would probably vote for no rate hike. I suspect the bank is probably just going to tip over into a rate hike at the decision tomorrow. But as I said, it's a very, very finely poised decision, and the bank loves to have internal disagreement.
And maybe that's the most healthy of all a discourse. I like the way you talked about a British pint of lager. This is the conundrum within inflation in the United Kingdom. CPI is the most expensive pint of lager. It's 3 times the cheapest. I mean, just take me behind the pint of lager and why you're using that analogy and why it matters. And do you think the Bank of England, they're like a pint of ale at Threadneedle Street, don't they?
Yes, although the price in London is not the highest price. That's an important point to bear in mind. So, if the Bank of England governor is popping out for a pint of beer before the MPC or possibly before the press conference, then he can get it a lot cheaper. The point here is that, firstly, there is a lot of divergence of inflation experience emerging, and the divergence has increased. That's one of the really interesting things, not just in the US. I mean, in the UK, it's also happening in the States.
Yeah.
The other thing about this, that it means that the inflation experience of some people is actually very different to the aggregate inflation experience. If you're living in the West Midlands, where a pint of beer is a little over £2, it's a far different experience to East Anglia, where it's over £6.50. So very, very different experience, and that means the spending power of consumers in different parts of the economy is noticeably different as well. Now, this, I think, is a bigger deal in the States. One could argue that the US doesn't have an inflation problem. It's got a Florida problem, because Florida is where the inflation's at. Lots of other parts of the States, inflation is back to within pre-pandemic ranges.
Manus, come on, you're in the US now. Do you need to avoid Florida? I think New York, come on, New York's got to be worse than Florida. Manus, how much do you feel it moving from Dubai there?
I feel food inflation here because I'm not cooking at the moment. And as for rent inflation, I mean, the broker that I've got, he's a little bit wealthier. The two brokers that I've got, they split the rent. But Paul, you know, inflation here is live. It is kicking. How does it, you know, there's the point. I can really feel inflation coming into this country from the Middle East.
No, and I appreciate, you know, you're looking for your townhouse and your place in the Hamptons and so on. It must be expensive.
His penthouse.
But when we're looking overall, a lot of prices in the United States in various parts, including in New York, have been coming down. Now, the price level is obviously going to be different from an area like the Middle East. You will see differences in the price level, but the inflation rate has actually become very subdued in cities like Chicago, Los Angeles, New York. Alaska has been having deflation recently, so absolutely falling prices coming through. So it's quite a wide range of experience that you've got in the United States. But lots of parts of the states, as I said, have got inflation sort of in the 2.5% to 3.5% range. Florida, unfortunately, is hovering around 8%.
So, Paul, how does the Fed solve a problem like Florida?
Well, of course, this is difficult. The Fed is looking at the economy as a whole, and it's got to try and decide where pressures are going overall. I mean, what I hope is that the Fed will take a look at the fact that wages, and I mean wages, not average hourly earnings, but proper wages, are slowing down. They're going to take a look at the fact that we know the fiction that is owner's equivalent rent, which is adding to inflation at the moment, that's going to come down in the future. And they will know that the lived inflation experience for a middle-income family that own their own home in the United States is actually significantly lower than the headline CPI. They'll know that they're in a more benign inflation environment overall. Churn in the labor market is slowing down, and they'll call a halt to the rate tightening. The important point to remember is if the Fed, or indeed the Bank of England, pause on interest rates, policy still gets tighter. Central banks are still pressuring economies slower if they do nothing, because real borrowing costs are going to be rising over the next 3 months, because quantitative policy continues to tighten. Everyone's gone quiet on quantitative policy. It's the second pillar of central bank policy, and it's continuing to tighten. So they are still tightening policy, even if they do nothing.
Should they be more active in it, Paul? Should they increase the Fed at this next decision today? Do you think we could get a hawkish surprise in the way of QT?
I think that's unlikely. I mean, never say never with Fed Chair Powell. I mean, after the June policy errors last year where policy guidance was torn up, I would never bet against anything happening under the Powell Fed. But I don't think that's required because, of course, what's happening is the economy has slowed, but the economy is still growing, and it's growing faster than the Fed initially expected. Now, an economy that is growing demands liquidity injections, but the Fed is pulling liquidity out of the market. So what you've got here is the Fed's balance sheet as a share of GDP is falling faster than the Fed would initially have anticipated because the economy is doing better, the economy is demanding more liquidity, and the Fed is taking away the pinch ball. So I don't think that there's a necessity to do more on quantitative policy. I think the fact that the economy is growing and the Fed is pulling away liquidity at the pace that it's doing is creating enough of a slowdown in the balance sheet to GDP ratio.
Well, I think the Fed learned from a few fumbles in QT under Bernanke. Very quickly, Paul, oil, lots of debate, $100. Will it be a second round effect or for central banks, or as you say, actually, Manus, it's going to crimp the consumer more? Briefly, the take on oil.
So I think it's more likely to be growth disinflationary. This time last year, consumers had more savings. They could cushion the oil price. This time, I think you'll get two effects, cutting in non-oil spending, but also don't forget, oil is now more flexible as a form of demand. People work from home. You're not driving the car. Oil demand goes down. Oil price up, more people work from home.
Although if you listen to a lot of executives, I should say, less folks are going to be able to work from home. Hey, Paul, I'm afraid we're going to have to end it there. Really wonderful to have you on the show, gearing us up for a big rest of the week. Paul Donovan of UBS Global Wealth Management, thanks so much. Now, coming up, we're going to have more on the market-moving events for you to watch throughout the day. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. Now a quick look at what's ahead today. Let's get you set up for your trading day. President Biden will be holding bilateral meetings with his Israeli and Brazilian counterpoints. That is at 10:15 a.m., 1 p.m. respectively in New York. And then we have today's main event. It's the Fed rate decision. That will be at 2 p.m., followed by Chair Powell's news conference at 2:30. Don't miss our special coverage. That will be at 1:30 Eastern. And then it's FedEx reporting its earnings after the market closed with eyes on any update on the carrier's cost-saving plans. Manis, before we can get through all of that, we have the Fed, and then we have the BOE, which, the way the market's trading, that could give us even more volatility than the Fed today.
Well, I think actually the Threadneedle Street probably needs to see a softer Fed and something from the PMIs tomorrow to perhaps help them. Danny, there is only one chart that defines rates risk, and it's at the short end of the UK curve. And this is where the CPI came in at the lowest level for 18 months, and down went the very short end of the curve, two-year yields dropping because there's going to be a very divided Bank of England tomorrow, according to Paul Donovan. Sterling's down by 1/8%. Of course, it's had a fairly good run from Trustonomics, but here you are. The gilt market now believes that the Bank of England, Threadneedle Street, have got the fodder that they need, the caveat that they need to deliver a pause. We need to qualify that pause.
Yeah, I'm still fascinated by what Paul Donovan just said to us, Manis, because we talk all the time about the ECB dealing with regional differences, that it's one policy for many nations. Well, what happens in the UK, where you have beer, as Paul said, more expensive in London than East Anglia, which you're going to show it to me on a map after the show, and in the US, where Florida is much more expensive than Chicago? How do you deal with that?
But then that is the conundrum. I mean, delivering an interest rate for more than 50 states, delivering an interest rate for the United Kingdom are two very, very different things. Rates aside, you're also seeing those US rates hit the highest level since 2007, and that was on the inflation pop that drifted over the border from Canada. So, you know, the nerves are jangling, and then you go into Bank of Japan on Friday, and I think that's all about the currency rather than the rates. What have we got on the pre-movers? Instacart, they were brave, weren't they?
Yeah, I mean, IPOing in a Fed week. I mean, look, ARM went in the CPI week, so maybe they gave them the all clear. But we are now under $32 on the pricing for Instacart. It priced at $30 before the IPO. It went up to $34. Manis, we're kind of getting close to undoing all of that IPO pop.
Yeah, I mean, it was what, up $42 a share. They sold it onto the floor at $30. I mean, it was a monster one. Last week, the accusation was that ARM left too much on the table. There's a couple of other things just to keep your eye across. Keep your eye on NVIDIA, along with the automakers in Europe. That'll drift through on the EV story here into the US session. Let's see whether there's a nice bump on that. But tomorrow, it is all about the bond market, isn't it, Danny?
Yeah, we're going to have coming up on the Bloomberg Brief. We'll be speaking with Oliver Kedewell of First Abu Dhabi Bank and Sarah Hewen of Standard Chartered. All right, that's it for the Bloomberg Brief. Surveillance is up ahead. Coverage out of London. We'll be talking to ARK Invest CEO Kathy Woods. Manis, good morning from London.
And good morning from New York.